0.1% today. Let's get you some movers. Equities gapping lower, yields gapping higher. With your movers, here's Abby.
Hey, John. Well, yeah, it's a really brutal start here for stocks. That S&P 500 back below its 20-day moving average, telling that the near-term dip buyers, they are out. And it has a lot to do with big tech. As you know, Apple down 2.2% at this point, down 2.1% moments ago. This as yields surge higher, as you were mentioning. Of course, that puts valuation into question. Tesla down 2.7%. That could have something to do with the Twitter lawsuit against Elon Musk, but also that tech piece of Tesla coming under pressure. Chevron down 0.8%. Oil plunging yesterday and the day before. Today down slightly, but still there's really nowhere to hide. I'm looking at the IMAP right now in the Bloomberg terminal, and all the sectors are lower, and that of course includes the banks. So even yields higher ahead of earnings tomorrow. Investors very, very nervous. And if we take a quick look at the NASDAQ 100 futures, we are going to see that big move lower into that hot CPI print, John. Stocks have been higher, but a massive leg lower as investors get nervous about what's ahead relative to the Fed raising rates.
Abby, thank you. Going into earnings, and Abby nailed it. You look at the banks, they can't get a bid when yields are down, and they can't seem to make it happen when yields are up 12 basis points today on a 2-year to 317. Your equity market breakdown: information technology down by 1.75%, consumer discretionary down by 1.9%. Tech in focus. Let's get to Ed Ludlow for a little bit more. Morning, Ed.
Yeah, good morning, John. Looking at the NASDAQ 100 and the biggest points movers to the downside, it's names like Apple, Amazon, Microsoft, Alphabet, the parent company of Google. When that inflation print hit, you looked at the pre-market activity. My eyes were on Amazon in particular, dropping like a stone in pre-market in reaction to that. Going into this earnings season, I think you and I discussed this last week, right? We're bracing for what is just a key earnings season. Earnings expectations in this sector have come down, and they're zeroed in on the consumer. This is the test. It's not just about what the Fed does with rates in line with the recession that we expect. It's how the consumer reacts and the readout we get from these companies. Amazon's a really interesting one, right? The third-party data tells us that Prime Day is going well. You see sales growth from Prime Day, which is a 2-day event currently ongoing, that could be in a region of 15 to 30%, depending on which third-party data you trust the most. Morgan Stanley and Brian Novak out with a note this morning saying that actually 2023 we could see top-line growth for Amazon accelerate and profit, because they've done a lot of work around fulfillment, right? They're sensitive to the price swings we've seen in fuel, diesel, for example, as well as the inflation story. But this is what we're zeroed into, the language around there. And you showed a slide a moment ago. We have seen price targets cut on a number of these mega cap names that I watch every single day, either being the biggest points gainers or points laggards, and big swings, because we're concerned that actually these guys won't hold up as well as they have done coming out of the pandemic.
Ed, thank you. Ed Ludlow there, highlighting Alphabet there as well. This is the line from Google and the CEO as they slow hiring. You need to show more hunger than we've shown on sunnier days. It's the latest from Google. More guidance from Delta. This is what Ed Bastian had to say. We've got to do everything we can, and we have been, to ensure that we serve the demand and serve the quality of the operation, and not try to grow beyond our means, which is tempting to do when you see the level of demand. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Well, Delta's down about 7% in the first few minutes of trading. The issue really being that profit missed expectations. Earnings per share coming in about 20 cents below the average analyst estimate at $1.44. And the issue here really is elevated costs. Everything from fuel to labor, just higher operating costs in general that these airlines are facing as it extends constraints on flying capacity. It says it will continue to do so for the rest of the year. The issue, as you allude to, John, is on the supply side, not on the demand side. And Bastian saying that in the last couple of months, they've seen a seismic shift in demand, and that they are not seeing signs yet of a pullback in travel spending in the face of higher inflation and a slowing economy. So they still are able to exercise some of that pricing power, which is why revenue for the third quarter guidance actually exceeded expectations. And remember, in that CPI data, airfares were up 34% year on year, even if they were down slightly month on month. So really it comes down to that pricing power issue. It's kind of an echo of what we've seen in earlier results this week, like Pepsi yesterday, in which revenue growth actually outpaced volume growth because pricing was up 12%. And consumers largely for Pepsi seem to tolerate that. So a few positive signals out there that they're still willing to spend. And on that note on spending, you can see that evident in credit card and debit card spending data out of Bank of America. In June, up 11% on a year-on-year basis. That report was released release last week in which Bank of America pointed out that spending on services like travel and entertainment is still boosted by pent-up demand, even as the share of card spending on gas hit 9.8%, John.
Kelly Lyons, thank you very much. Trying to stay on top of a lot here. Euro dollar with a brief flake of parity. Just briefly, right now it's above that level. You will hear from central bankers, and when you ask them about the FX market, they will tell you they don't target foreign exchange. But ultimately, the FX channel is important for price stability. That's the way they talk about it. This is what we're hearing from the ECB right now. We are attentive to the impact of the exchange rate on inflation. The ECB does not target a particular exchange rate, but we are attentive to the impact of the exchange rate on inflation. That's the latest from the ECB. Otherwise translated as, we don't want a weak euro right now because that is exacerbating the inflation story. The problem they've got at the moment, though, you've got to ask yourself this: how relevant is the rate story to foreign exchange in Europe right now? When I speak to a lot of FX strategists right now, and they tell me perhaps the most important thing next week is not what happens with the ECB, it's what happens with Nord Stream 1. And that's the difficulty this ECB has, and why many people believe President Lagarde is stuck between a rock and a hard place. Euro dollar right now just above parity. That's the European economy. Let's talk about the American one. Mike Gaper over at Bank of America now writing this: we now forecast a mild recession in the US economy this year and expect 4Q real GDP in 22 to decline 1.4%, a moderate downturn this year, and below trend growth for much of next year, pushing the unemployment rate 1 percentage point higher from 3.6% currently to 4.6. I'm pleased to say that the head of US economics over at Bank of America, Michael Gapen, joins us right now. Mike, fantastic to see you in a new seat, but we've got to talk about this data before we sit on that topic for too long. So let's do that right now. Your response to inflation from an hour ago.
Well, I think it gives you the indication, certainly, that domestic price pressures are still quite strong and quite robust. So there's been a narrative, as you know, in recent days and weeks that energy prices are moving lower. That should provide some relief to U.S. consumers. That is indeed true. But I think today's report tells you underneath that are still inflationary pressures that are very strong, and we think the Fed will look at the labor market data and the inflation data and conclude it needs to keep moving at a rapid clip. So the price data today is not very comforting for us from the perspective of how easy will it be for consumers to keep up spending in an environment where inflation is elevated.
There's two ways of looking at it, though. You could sit here and say this is the last really bad number, or you could say it's the early signs that this is getting stickier. If you had to take a side on that debate right now, Mike, which one would you pick?
Well, I think we're in the latter camp where we think inflation will be a little more stickier, certainly at the core level, the underlying level. Yes, energy prices are moving lower. It should give at least some help for consumers in the coming months. But we do see evidence that household spending and domestic demand is slowing as we get into the end of the second quarter. We're actually forecasting a decline in GDP now for the second quarter. So we're seeing some evidence and momentum, and there is this trade-off between what is the spot data telling you the economy is still quite strong and robust, spending is still fairly elevated, but trends from our perspective are becoming more worrisome.
Mike, can you talk to me about this growth call then? You touched on it there, and we started the segment with it. What's the character of this recession? Give me the detail. Is this the technical definition of a recession, 2 consecutive GDP declines, or is this going to be the MBER definition of a recession, one that's accompanied perhaps with a labour market breakdown too?
Yeah, I think that at present, would I say that we're in a recession now? No, and I don't think, yes, by the technical standard it would be. I don't think the NBER would conclude that. Our story is more about, say, an NBER-defined recession later this year, probably more along the lines of Q4. It would just be an idea that it'll be difficult for services spending to hold up in an environment where inflation is strong and as persistent as it is. It means the Fed still has more work to do, and you could see at least a temporary break in hiring later this year. It is not a deep downturn from our perspective. It's just the idea that you're going to need a little more pain in the domestic economy to bring inflation down over time. So I'd say if it's an NBER story, and when do we get to that kind of recession? Later this year. We don't think we're there now.
So Mike, that pain that you mentioned includes a 1 percentage point climb in the unemployment rate. That's in your forecast. I had a question earlier this morning from someone smarter than me about that forecast. And they basically asked, given the participation rate right now and given where it is and how low it is, how much damage to employment would need to happen to get unemployment up?
Yeah, I mean, so I think the argument here, just in the broader context, is it's very unusual for the unemployment rate to simply rise a few tenths of a percent. When it goes, it typically goes a full percentage point or more. So we're talking about employment slowing down and being negative, say, for 3 or 4 months or 3 months or so later this year, but then average rates of employment growth, that would be more in the 100 to 150,000 range over the next year. So compared to where we are currently, that's a big drop-off, but that would be consistent more with, a normal rate of employment growth at the late stage of the cycle.
Mike, I can say this honestly, fantastic to catch up with you, just brilliant, and Bank of America are lucky to have you with you. The head of US economics there, Michael Gapin of B of A, who we're going to be catching up with a lot over the next couple of months, I'm happy to say. Your equity market's down about 8 or 9 tenths of 1% on the S&P. On the Nasdaq, it's down by 1.2. We're coming off the lows here. Looking at the bond market yields, still up about 12 basis points at the front end. The 2-year 3.17. Evan Brown of UBS has a different take of things. This is what he has to say. A soft landing is certainly achievable, but the path to get there may feature a sharp deceleration in the data that makes it difficult for market participants to distinguish between a benign endgame and a recession. Evan joins us right now. Evan, walk me through what all of this means for this market, for you and the team.
Yeah, so markets, in the end, sequencing matters, right? And so we have the destination, which a very good chance it could be a recession. Very good chance still that it can be a soft landing. I mean, there's still solid household balance sheets. There's still China stimulating. We're coming from a decent starting point, a very strong starting point from housing and manufacturing, which is decelerating. But again, the underlying starting points matter. But just this path is going to be really difficult for markets to trade, because you are seeing this slowing data, even if it's coming from a decent starting point. And this inflation print, it's a problem, right? So it's a problem for the Fed. It's going to be very difficult to get off 75 basis point hikes as long as inflation is not durably coming down. And look, tightening policy into slowing growth is just not a good combo for risk assets.
With that in mind, Evan, and I know it's not your base case, you don't see a recession necessarily. What you do see, though, is a market that's going to keep pricing it in. Do we do that more through the equity side of the story? Do you push that through credit a little bit more? Are you expecting the yield curve to take on a different shape, perhaps even be even more inverted? Where are you pushing that view through?
Yeah, I think, and we are cross assets, so we're looking for the best risk reward opportunities. But I think equity is still the cleanest play for a negative view. So being underweight or short equities here, because that way you're getting both the pressure of the tightening and the slowing growth. Fixed income is a little trickier. What's happening with the curve. Certainly, it looks like a flattener, but we could get that slowing growth really taking hold as well. And so fixed income's trickier here. I think in credit, there's room for more widening, but when we look out, credit is becoming more attractive, and you pay a lot of carry to be negative on high yield, for example, here. So equities, we think, is the better play at this point.
We'll keep building on that equity story with you. Evan, you're going to be sticking with us. Evan Brown there of UBS. Your equity market down 1% on the S&P. Coming up, bank earnings kicking off tomorrow.
There's going to be, like we've seen in the past couple of earnings seasons, some positives and some risks.
That conversation, up next.
There's going to be, like we've seen in the past couple of earnings seasons, some positives and some risks. On the positive side, rates are higher. That's a plus. Loan growth is off the charts, really hot. But there are negatives out there. Number one, deposit betas are rising. We've got expenses on the rise with inflation pressures. And frankly, at some of the institutions, we're expecting some buybacks to stop.
Investors gearing up for the big bank results. JP Morgan, Morgan Stanley kicking things off tomorrow morning. On top of that, Wall Street correspondent Sonali Basak joins us right now. Sonali, run us through what you're looking for tomorrow and beyond.
Yeah, you have to wonder if Bank of America is predicting a mild recession, John. What does that look like in terms of loan loss provisioning? Are we going to see those come back to the banks at a time where interest rates are rising and they're really excited about loans and net interest income? Even though trading is expected to rise to more than $20 billion, almost $30 billion across the biggest of banks, you also see an expectation that loans will grow significantly, bringing in more than $50 billion. You have JP Morgan already having said during the quarter that they are raising their net interest income expectations. So that is the good news. But the bad news is you're looking at a deeply, deeply inverted 2-10 yield curve. Remember, banks borrow short, lend long, and you're looking at a differential of 15 basis points. That was 8 just yesterday. So what kind of impact do you have when there's so many recessionary views ahead and the consumer may want to put more money away than borrow more?
Sonali, looking forward to your coverage. I always am. It kicks off tomorrow morning. We'll do that on Bloomberg Surveillance as the numbers pour in. Evan Brown of UBS joins us back on the program. Evan, let's talk about the earnings. The buzzwords this earnings season: recession, inflation, foreign exchange, layoffs. What's the number one for you that you're looking for?
You know, I think it's still cost pressures, actually. I mean, I think that we have to keep a very close eye on margins. We're getting still really strong employment data with GDP that's quite weak, and that is a real issue for corporate profitability. So we'll be looking at margins and costs in particular.
Evan, within the equity market, there's been this temptation maybe to gravitate back towards the tech names, some kind of defensive stance. Bank of America's pushed back against that view. What's your view on it?
Yeah, we don't like tech here. As long as inflation is coming in hot, then any asset that was built on this idea of low interest rates for forever is going to get hit. And so, yes, valuations have come down for a lot of these companies, but we still have a Fed that's tightening really aggressively, and there's still, valuations even for these super caps are still really quite elevated in the grand context of things. So more room for downside in tech in this environment.
So Evan, where do I find that diversification, those risk mitigating characteristics, that resiliency in my portfolio again? Where do I get it again? Do I get it outside of the United States? It's not Europe right now, that's for sure. Do I find it in Asia, in China? Where am I getting that uncorrelated defensive type resiliency back in a portfolio?
Yeah, so if you want less correlation, it's in China, and I think you've got a decent story in China, right? It's the only place in the world of major countries that they're stimulating, not tightening. Zero COVID, tech regulation, these things remain a challenge, but they're getting progressively less bad, and that matters when you have a market that's still quite cheap relative to a lot of other markets. So China's the one area that we want to allocate some risk globally.
Evan, awesome to catch up following the inflation report an hour ago. Still lost for words around it. Evan Brown there of UBS. CPI, the 9 handle. Do we have to get used to that? Maybe not. Had some pushback against that view this morning from David Kelly of JP Morgan, who suggested this is the last really bad one, that a lot of this is dated around the energy story. The president just put out a statement on inflation in June, and it echoed some of that. I'll read some of it to you. Well, today's headline inflation reading is unacceptably high. It's also out of date. According to the president, energy alone comprised nearly half of the monthly increase in inflation. Today's data does not reflect the full impact of nearly 30 days of decreases in gas prices that have reduced the price of the pump by about 40 cents since mid-June. On that front, the president absolutely correct, and most economists on Wall Street agree with him. What doesn't come up with this statement, though, is rents and shelter. And the rent of primary residences rose 0.8% from May, the largest monthly advance since 1986. Shelter costs overall, which are the biggest services component and make up a third of the overall CPI index, climbed 0.6%. And this is the conversation that's taking place on Wall Street about what will ultimately develop in this economy. Can we come down from 9 to 8 to 7? Can the energy story fade? In July, perhaps the data is indicating that's what we might get. On core, though, when it comes to shelter prices, how sticky is that going to be? And I keep going back to that comment from Mohamed Al-Arian just a week ago. That is the number one question for us now in this market. How sticky will inflation be? How much work will this Fed need to do? And how much damage will they inflict on this economy in the process? And that goes back to what we heard from Michael Gapin there of Bank of America about 20 minutes ago, who said that we'll get that recession in America this year. Equities recovering just a little bit. Up next on the program, your trading diary from New York City, another big inflation surprise for America. This is Bloomberg. 25 minutes in, equities off the lows just about. We're down 0.8% on the S&P, call it 0.9 lower. On the Nasdaq 100, we're down about 1 full percentage point. That's the price action. Here's your trading diary. President Biden arriving in Jerusalem later this morning. Big bank earnings kicking off on Thursday with JP Morgan and Morgan Stanley, plus US PPI and another round of jobless claims. Fed speak through the week. Bostic and Bullard on deck later this week. And finally, President Biden heads to Saudi Arabia, followed by UMich consumer sentiment and US retail sales to end the week. Citi just published. The base case is still 75 basis points at the end of this month from this Fed. They say, though, we cannot rule out the possibility of a larger 100 basis point hike or additional 75 basis point hikes beyond this month. A lot to think about. Another big inflation surprise. Thank you for sharing this moment with us. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, July 13th. Here are the top market stories that we're following for you at this hour. Hot inflation, hot Fed. U.S. prices topping 9%, and the market sees a more aggressive Fed. How far can the Fed push? And at parity, party. Now what? Euro breaks below 1 with the dollar after U.S. inflation hits that 41-year high. Yields soar, equities fall. And Europe's dire energy crisis. Europe is running out of options as a drought hits the continent. We're going to speak to Adair Turner, Energy Transitions Commission Chair. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, we can kiss that inflation's going to come down fast thing right out the window.
So the question is, does the Fed need to go 100? The Bank of Canada just has. It's just raised by 100 basis points, well above not well above expectations, but at the top end of expectations. The expectation was 75. They decided not to do that. The line also coming out of the Bank of Canada is that it is opting to, quote, front load the path and says more hikes might be needed. So, Alex, Bank of Canada can do it. Can the Fed do it?
Yeah, why not?
It looks as if the market's beginning to price that as a possibility. I think it's now a 1 in 3 chance that the Fed will go 75, will go 100 in July. Still 75, therefore the base case, and that has been crystallized over the last few days. But Citi's just said it can't rule it out. The market clearly can't rule it out. And the Bank of Canada has just shown how you do it. So that's our question of the day, Alex. 100 basis points, fairly straightforward. I guess we could have applied it to the Bank of Canada, but we already know the answer now to that question. So let's bring in Bloomberg International Economics and Policy Correspondent Mike McKee, Ira Jersey, Chief U.S. Rate Strategist at Bloomberg Intelligence, also joining us. Ira, the Bank of Canada can do it. Why not the Fed?
Well, they certainly could. I think the challenge for the Fed is because they've already been hiking a little bit faster than the Bank of Canada has so far. The question is, will it be seen as the Fed panicking, admitting that they're behind the curve when it comes to inflation? So I do think that the Fed is going to talk about 100 for sure, but with some prices like energy prices a little bit lower than they had been last month, that maybe they'll see some price pressures easing. So I think we have to consider from a market perspective the base case more of 75 in July and then another 75 in September as being the higher probability than 100 basis points in any given month.
Mike, on the flip side though, the headline number is a sexy number, but the core month-on-month was actually a lot stickier as well. And core services, even if you back out rent and shelter, is still rising. That might make the case that you have to and can go faster.
Maybe. I think that in this case, the Esther George dissent from the June meeting comes into play. Her argument is that monetary policy works with a lag. And so if you do a very high amount of tightening very early, you're not going to know when it hits the economy exactly, and that could do a lot of damage if it hits it wrong. And you've got Bank of America this morning coming out and saying we would have a recession this year. And so if the monetary policy the Fed adopts in July hits the economy in December, January, February, and we're in recession, that's going to be bad news. So I think Ira maybe has it right. 75 baked in now for July. There's no question about that. And then they could have a base case of 75 in September that could be dialed back if we get a drop in inflation and we still see strong job numbers.
75 in September. September, Mike, feels like an awfully long way away. I appreciate that it isn't, but this data keeps coming in above expectations, and I've heard a lot of people on this channel talking today about the fact that this could be the peak. But nevertheless, we are continuing to see upside surprises on September, which puts the Fed in some ways further behind the curve.
Well, it could. We do get 2 more CPI releases before the September Fed meeting, and we get 2 jobs numbers. So we will see some progress in the economy one way or the other, not to mention retail sales and personal spending. So the Fed still has time to figure out what's going to happen. And 75 basis points again in July after 75 in June is 150, and that's a lot in a very short period of time. So it is very possible the economy does start to slow, and maybe then the Fed wants to be a little bit more cautious. It's kind of hard to know exactly how far behind the curve they might be because you don't know when policy is going to hit the economy and what it's going to look like at that time.
Well, the policy might have that time, but markets always move before it, and that leads me to the yield curve, right? You got 210, 2's trading at 315, you got the 10's trading at 302, you're looking at 13 basis point spread now on that inversion. Ira, how far can the Fed push that inversion before stuff breaks?
Well, I think that we'll actually become much more inverted than we are now. So we're targeting 30 basis points, but certainly something like 40 basis points of inverted 2's 10's curve is not is not an impossibility at all. And that would be similar to the inversions that we had back in the 90s and basically 1989 and 2000 during those economic cycles. So not a huge surprise. And in part we get there because the market is still not pricing for the Federal Reserve to hike more than it was pricing, say, in May. So right now the market is still thinking, okay, regardless of how fast the Fed hikes today, we still don't think that they're going to go to 4%. So, and I think that ultimately will be repriced because of what Alex noted before. Inflation is looks like it's going to be a bit stickier. You have core services prices growing at a reasonably good clip now, and that tends not to turn around as quickly as things like food and energy prices.
By extension, can we think about where the market is pricing cuts, Ira? The market is currently pricing cuts fairly quickly after we get to whatever that terminal rate is going to be. Do you think there's a danger that those cuts are being priced early and ultimately they may need to be pushed out as well?
Well, I think there's two parts to that, guy. So number one is, yes, maybe they're being priced a little bit too early. The Fed is probably not going to, hike in March and then start to cut in September necessarily. But once the Fed does cut, they're not only going to cut once or twice as the market's currently pricing. They're more likely to cut, several hundred basis points, particularly if they hike and that terminal rate does end up, as we suspect, closer to 4%. When they initially cut, they'll cut by 50s and 75s. So they're not going to cut by 25 basis points only twice. So, so I think that yes, maybe the market is pricing cuts a little bit too early, but it's also pricing cuts certainly a little bit too optimistically that they'll only have to take back a couple of hikes instead of, basically fight off a recession by cutting several hundred basis points.
Mike, before we get there, the Fed has to see material change in inflation. How fast can the Fed really get this 9% number down? And even if we go with the core month-on-month, right, we're still around 5-6%. How fast, at this point, can it really come down? Meaning that the longer it stays higher, isn't it the harder it is to bring it down?
Well, it's not necessarily harder to bring down if it stays up. It would be harder to bring down if that 9% gets into inflation psychology and we start into that wage price spiral that the Fed dreads so much. We haven't seen signs of that, but I'll be with you at 10 o'clock on Friday when we get the latest University of Michigan inflation expectations numbers. The Fed is going to have to admit that it is not going to meet its inflation targets this year or next year. It's going to have to raise them again because it's just taking longer to get anything moving. Inflation fairly broad-based now. We will see it come off because oil and energy prices, gasoline has come down way down now 28 days in a row. The dollar strength is going to help with inflation. And so down the road, inflation is going to start coming down, but it isn't going to come down as fast as the Fed had hoped.
Yeah. Mike, to that point, final quick question to you. The Fed has a dual mandate. If we are going to get a recession, if we are going to see this economy turning, if we are going to see inflation coming down relatively quickly, are we going to find ourselves in a position where suddenly the Fed flips to worrying about what's happening with the labor market? And how does that change its behavior?
Well, if the labor market moves really rapidly, then the Fed would start sending signals first that it would either slow down or stop raising rates. And then wait and see what happens with the economy, and then they could cut rates. But we have a long way to go. The Fed is talking about unemployment in the 4s, and we're at 3.6%, could go lower than that, given the participation rates that we're seeing. So it's going to take some months for the unemployment rate to really rise, because this isn't the kind of potential slowdown / recession that we saw with the great financial crisis, and certainly not with COVID, where everybody's thrown out of work all at once. This is just a slow, grinding slowing of the economy.
Guys, thanks a lot. Really great roundtable. Love the insight. Truly appreciate it. Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence. Thanks very much. The market reaction, though, really clear. Sell stocks, sell bonds. So coming up, what does the Fed do next? We'll continue that conversation now on how to invest in position with Katrina Dudley of Franklin Mutual. This is Bloomberg.
Earnings season is here.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
Right now, they are hyper-focused, solely focused on inflation, and that is their key objective, getting that price stability. So if they need another 75 in July and 3 more 75 rate hikes by the end of the year, I think they'd be willing to do it. Do I think that's the appropriate pathway? Absolutely not.
That was Stifel Chief Economist Lindsay Piesga on Bloomberg Television. So that takes us back to the question of the day. 100 basis points. Does it happen from the Fed? It happened with the Bank of Canada. Joining us now, Katrina Dudley, Franklin Mutual Advisors, investment strategist and portfolio manager. Katrina, 100?
Nope, it's not happening. They are not doing 100. The Canadians may have done it, but the Fed, I think, is likely to stick to the 50, 75 basis at the most aggressive.
So 75, Katrina, what does that do to current asset prices?
I think the market's already pricing this in. That's the nice thing about having the Fed forward guidance. And I think that the market has already adjusted to that. You've seen that in terms of multiples starting to compress. You've seen it in the tech sector where you've seen a lot of that sell-off already. As we look at it, though, we're in a situation at the moment where these rate rises are coming as growth is starting to slow. And that's a real concern because you have high inflation and low growth. And if you look over over to Europe, that is a very untenable position that the ECB is in, and now potentially the Fed's going to be in.
So let's just say for the Fed for just one more second here. So even if they don't go 100, how many 75 bips can they get to before they break things?
I think it's very difficult to tell because everything's moving. You have a look at the situation with the energy prices here in the United States. You look at what that's doing to the low-end consumer. You see that through the retail numbers. So there's a bit of a trade-off where we have other factors now that are influencing the market. Yes, we're all talking about rates and we're talking about inflation, but there are a lot of other factors that are going to play into whether or not the Fed does 175, does 2, or even 3.
Katrina, I hear what you're saying, and you're talking about a lot of moving parts. Your degree of certainty as to what the path between now and year end looks like for the bond market, the treasury market, the S&P, how easy is it to pick it in this kind of environment? We're trying to work out what happens with inflation. We don't really have a huge handle on that, it seems. We're trying to work out what happens with growth. We could be about to see a recession in the United States, certainly Bank of America pointing to that possibility. But it's very woolly. It's very hard to see what's going to happen here. I don't know, therefore, how I can extrapolate back into markets to get a good handle with any degree of certainty without a huge amount of volatility in my portfolio.
Yes, I think volatility is here to stay. If I look at what's happening in the market, we're starting to see signs of growth slowing, and a lot of that is driven by pricing now starting to impact demand. So if you look at Parker Hannifin, which is a quintessential, short cycle industrial company, Evercore ISI just surveyed all of their North American distributors and found out that their ability to pass on these higher costs through bigger price increases is starting to kind of come under pressure because they're seeing the demand destruction. And that type of tightrope that companies are walking is similar to the tightrope that the Fed needs to walk. They need to raise rates in order to curtail inflation, but they can't raise them too much that they start to generate, as you talk about, a recession. The other thing that we're a little concerned about is that we talk ourselves into a recession. And if we do that, though, we think it'll be much more of a mild recession than a significant, large downturn in the economy. And that's driven by a number of factors in terms of you look at the housing market and the stability and the lack of supply we have there, and that will generate, economic activity. We look at the supply chain challenges, and those supply chain challenges means that there's not a lot of excess in supply chains and inventory levels. So we're actually kind of positive that even if we do have a recession, it's going to be a small blip on the horizon. So as you take that and you look at companies, instead of having your significant declines in revenues, maybe revenues flatten out and are down slightly. So the earnings hit is going to be much more manageable this time around.
So where do you go in that environment? Particularly as cash is now worth something. So there's also a case to be made for just sitting in cash until we get that kind of clarity. Otherwise, where do you put it?
Look, sitting in cash, though, with inflation at the levels that it is actually still value destructive. So I'm not necessarily sure that cash is your best alternative here. So one of the sectors that we're very positive on is I've talked about the home building sector. And I think this is a situation where you need to separate out stocks from your perception of what's happening in the general home building market. A lot of people are thinking after significant price rises and the increase in mortgage rates that people are not going to be buying houses. We don't think that is the case. We think that the market is very undersupplied, and we're extremely positive on the ability of the home building sector to meet that increasing demand. And that demand is actually driven by life changes. People having children, needing bigger houses, and not wanting to, live in a small one-bedroom apartment. So those demographic changes are supported by a strong economy, and we think that that's going to drive the home builders and be positive for them.
Katrina, if the Russians cut off the gas to Europe, if Europe goes into a free fall economically, what impact does that have feeding back into the US market?
If the Russians do cut off the gas, I think the hit to GDP next year is estimated about 3%. Obviously, there are some offsets that can happen. We can have imported gas coming into the market. Canada's looking to play a big role there. We can have an accelerated shift to renewables, and there are other different forms of energy. So I think that there are ways to offset that fairly significant hit if Russia was completely cut the gas off. And Europe's already announced an intention inflation to basically wean itself off Russian gas, and Russia knows that. In terms of the trade-off, however, we're looking at an ECB that's facing increasing inflation pressures. Those are driven by higher food prices, the result of the Ukrainian crisis, as well as higher energy prices, which are also. So what could happen that's positive? Because I hate always talking about the negative. Maybe we do have an abrupt end to the active war in Ukraine, and that will cause gas prices to normalize to a much more manageable level. We'll start to see those food supplies come back on, and that is the surprise that could come in the second half of this year. And I think if that happens, all this talk about a recession will be taken off the table.
I hope you're right. Sounds like a pretty good outcome from where we're sitting right now. Katrina, thank you very much indeed. Katrina Dudley, Franklin Mutual Advisors. Thank you very much. This is Bloomberg.
This is Bloomberg.
So Delta's call just getting underway. Bastian speaking, talking about what is happening on the wage front, the worker front. That's the story right now. Second quarter earnings missing expectations. First major U.S. airline, of course, to report second quarter results. Brooke Sutherland of Bloomberg Opinion joining us now to discuss. I feel that this is a familiar theme now, Brooke. Airlines are struggling. They're struggling to get staff. In the States, it feels like it's a pilot story. It's maybe an ATC story as well added on top of that. Here in Europe, it's a ground handling story. But it's a familiar theme. When is this going to end? Are we getting any clues from Delta about how long this is going to last?
I mean, I think what they're signaling is that they don't necessarily know when it's going to end, and they expect operating costs to be elevated for a while. They are targeting less capacity, fewer flights. That seems to be the U.S. solution to this problem is, the way to curb disruption is just to put fewer planes in the air and, hope that the ones that they are flying do get to their destinations on time and without having their journeys canceled. But of course, that does come with a downside. If you are an airline, that means you have fewer seats to spread around these higher labor and fuel costs, which are not necessarily getting any better for the airlines. Now, I think the key question that you have to have as an investor is, will the demand still be there by the time that the system catches up to the interest that we're seeing in flying right now? I just heard from somebody the other day who said, you know what, I was going to travel, I just canceled it. I didn't want to deal with the hassle. And so I think the airlines need to be really careful here about the impact that some of these disruptions are going to have on travel demand. It's one thing to pay higher prices for flights when we've all been cooped up for several years. it's another to pay those prices and then see your flight repeatedly delayed, to get rebooked, to get canceled, to spend the night in the airport. I mean, that's a lot to ask the consumer to digest. And I think you have to be concerned about, how demand is going to hold up under those conditions.
Yeah, especially as we're dealing with a huge cost of living increase at the same time. Hey, Brooke, I'm really interested in the stock move. So Delta stock today down by about 8.5%. I'm surprised how surprised the market was at this.
I would agree with that. I am also surprised. To Guy's point, it is not like this has necessarily been a secret, the challenges that the airlines are having. I do think, you have to take Delta's results in the context of the inflation data that we got today, that, we are not necessarily seeing a peak in those consumer price pressures, which does sort of factor into that question that I'm talking about of how well can travel demand hold up. This has been relatively immune to inflation so far. I think that's a reflection of the pent-up demand that the consumer has for travel. This has not been an area where you could spend money for the better part of the last 2 years, and people are really eager to get out and travel. One thing I thought was interesting from Delta's results is they're still seeing stronger demand for those premium products, even relative to their coach. Now, this has been a trend across the industry, but clearly speaks to that desire to travel. But of course, the big question is how long does that last?
Brooke, can they bring fares down with jet fuel this high?
I think it's going to be tricky for them to do that, and I also don't know if they're particularly incentivized to do that, given some of the questions about the demand picture. I mean, I think they want to take the profits where they can right now. They're not having trouble pushing through higher fares at the moment, and so I don't really know what the incentive is to reverse that and bring them down.
Hey, Brooke, really appreciate it. Thank you so much. Brooke Sutherland of Bloomberg Opinion. We appreciate that. I have zero desire to get on a plane. Maybe 2023. All right, coming up, Europe's energy crisis is turning even worse, and it's also leading to a return to coal. What does this mean for the landscape for alternative energy and how quickly Europe can pivot to that? We're going to discuss with Lord Adair Turner, Energy Transitions Commission Chair. This is Bloomberg. All right, we're an hour into U.S. trading. Stocks right around the lows of the session. Barclays, the latest big bank, looking for an aggressive 50 basis point hike in September and 75 bips in July. Bloomberg's Abigail Doolittle is tracking all the moves in the market. Abigail?
Well, Alex, it turned out to be a bit of a brutal day here. The S&P 500 down 1.1%. Earlier in the pre-market, the indexes had been higher, but on that super hot CPI print, we've had a real reversal of fortune for stocks. The S&P 500 now down for a fourth day in a row. Delta Airlines underperforming, unlike American Airlines that pre-announced to the upside yesterday. Their quarterly report negative. They were unable to meet the profit estimates on rising costs, and it sounds as though they're cautious about the future. So a bit of a divergence between those two big airlines. Lennar, the home builder, down 1.8%. JP Morgan downgraded this stock to a neutral from an overweight on that hot CPI print. And talking about the hot CPI print, you have the short end of the curve really moving sharply higher. That 2-year yield now at 3.13%. The 10-year yield, last time I looked, going down a little bit. So that yield curve continues to invert, and it suggests the most inverted since 2007. It suggests that that recession everybody's talking about could happen. Now, the action we're seeing for the S&P 500 today is very fitting to what we've had over the last 6 months, because each time that the CPI print has come out, and typically hotter than expected, we've seen some pretty big declines for the S&P 500. Two nearly 3% declines. Right now we're looking at about 1.1, 1.2%. The question is, we did have this bear market bounce developing over the last 3 weeks. Is it gone? Not so much, but it's become a little bit more tenuous. This is a 1-year chart thereabouts of the S&P 500. Here's this trend channel that's been pretty reliable all year. The bear market down more than 20%. You can see that there's this uptrend here within the trend channel. The RSI still looks like it may rise. The question, though, is will it hold that last low? So long as that last low is held, it does look like the bear market bounce could continue, that maybe the near-term bulls will step in, maybe on earnings. Let's see. A very bumpy ride for sure. And then finally, back to the inflation point. Let's take a look at it on the year. This is really incredible. These numbers are stunning for the commodity complex. You have crude oil on the year down 21%. This is actually not on the year, but since the last GPI survey. Gasoline down 18.6%. Wheat futures down 24%. And then you can see copper also down 23%. So over the last month or so, the inflation has come in, but of course that comes after a huge surge higher guy. So let's see how much it can moderate in terms of the big gains. But that CPI print being hot, certainly pressuring all markets.
Absolutely. It was interesting to hear the president make the point about what you've just been talking about, Abigail, the fact that energy costs have come down since the last CPI print. He talked about the fact that today's data are very much in the rearview mirror. But let's carry on the conversation surrounding what's happening with energy, this time from a European and Asian focus. So what do we got here? We've got gas being cut off. We've got drought conditions in Europe, which is going to curtail nuclear in a very big way. And those high prices mean that actually what we're seeing here as well is those high temperatures also means that we're seeing a huge demand at the moment for energy. So what we're seeing here in Europe now is a huge shift towards coal. You're seeing some of the older coal plants starting to be recommissioned. They're starting to come back into action. And we've got the chart here that will show you, as a result of which, what we're seeing is coal pushing up very strongly over the last few weeks. In fact, European 1-year forward coal is now at a record. The top line there, the white line, is Asia. The blue line is Europe. And this is going to have a huge economic effect, but we're also going to see a huge effect coming through in the form of emissions, which is something that we're going to have to pay a great deal of attention to. Europe is firmly focused on getting to net zero. This move back to coal is only going to get in the way. If you want a real kicker to this story, Deutsche Bank is trying to model the economic effects of the moment of switching from gas to wood. That's kind of where we are right now. People are trying to understand what the economic effect is of people burning more wood this winter in their stoves at home is going to be. It's going to certainly have a big effect in terms of the emissions story. Where does that leave us in terms of the move to net zero? I think that's a challenge that all governments are now going to have to deal with. Business groups in the UK, Amazon, Unilever, Coca-Cola, very much also calling on the new UK government to stick to the net zero targets that have been set. In an open letter, they have said, quote, we have seen firsthand that investment in low carbon infrastructure and technologies delivers huge economic benefits. Supportive policy measures bring down costs of clean technology, enabling businesses to capitalize on growing global markets. Too many G's in there. Joining us now is Adair Turner, Chair of the Energy Transitions Commission. He formerly, of course, of the CBI and many other hats that he's worn over the years.